My name is David Hanna. I'm a chartered accountant, chartered tax advisor. I've worked in stamp duty since its introduction in 2003. I'm joined today by Andrew Marr, who is also a chartered accountant, chartered tax advisor, managing partner of Forbes Dawson, a specialist tax firm in South Manchester, and a long-time colleague and co-author of mine on this subject. We're also joined by Roger Bin-Shedler, who is the technical director of SDLT Compass, which is a piece of stamp duty calculation and auditing software. Roger, for his sins, has worked for very many city law firms. Before he became to the side of Angels, he worked for HM Revenue and Customs as both a prosecutor in their policy unit, and as a result of which, being a fully civil service trained lawyer, he never uses 10 words when 100 will do. There's a reason for which I've actually got him on a stopwatch. But anyway, good afternoon to you all. The issue with stamp duty and pension schemes is that there is a widespread belief that if I sell you a property and you give me cash, you pay tax. And ordinarily, that would be the case. However, certain properties sold to a person's pension scheme may not be liable to SDLT if the seller is a partnership, and more controversially, if the pension scheme itself can properly be regarded as a partnership, because where a partnership is involved, either as vendor or purchaser, special rules apply. These rules have been in place since 2007, by the way. Been around a while. What seems to be the problem is that law firms are not familiar with the intricacies of this particular area. It is a specialist anti-avoidance provision. Now you might go, hang on a minute, how can an anti-avoidance provision cause a nil tax result? When the provisions were first introduced in 2005 and then they were modified over 2 years, HMRC accepted, and they were originally introduced to stop the large-scale avoidance of SDLT by offshore corporate partnerships. So what used to happen, if in the good old days, what you used to do, I'd bung in 20 million, you'd bung in £20 million worth of property, we'd run a partnership for 12 months, and then we'd both come out with each other's capital, i.e. I'd take the property, you'd take the cash, and there was no SDLT. So they introduced this provision to deal with it. And the revenue accept, however, where the connected person is outside the partnership but connected to all the partners, it does produce a nil result. And I've got some statistics for you which might be slightly shocking. Not those, they're the small print. But as we've said, property passed from multiple owners to SIPPs and SSASs or related vehicles, whether in specie or buy for cash, come under Schedule 15. And so SDLT may not be payable. We've done quite a number of jobs over the last 2 years. In some cases, we've even found that the sale and leaseback relief, Section 57A, FA03, in case you're interested, hasn't been claimed on the lease back to the originating business. That is slightly concerning because that is a straightforward situation. We've already obtained refunds of tax on behalf of SSASs, SIPPs. We've done advanced clearances, we've done pre-completion advice. And just to give you an idea, you won't be able to read the small print. You may be aware that the revenue have up to 12 months to dispute a return or indeed argue against a refund. On pension schemes, we've done 35 in total. 25 of those have gone over 12 months with no dispute. 10 are still inside the 12-month window, but I quite clearly don't expect a problem. Interestingly, in the same period, we've done other transactions, partnership incorporations, disincorporations, those sort of things. We've done 29 of those. 16 have gone over the 12 months, 13 are waiting. HMRC have never disputed this advice since 2007. And since that period, Cornerstone have done over 1,000 of these transactions. And I cannot emphasise this enough. We have never had a revenue inquiry. And we've written to them explaining why we're not doing a return in every single case. The opportunity was there, they did not take it. I'm going to say to you now, because HMRC accept this position, and it's been accepted since 2007. So let's talk about the basic paradigm situation. Do you want to step in at this point, Andrew, in case I run out of steam, or are you quite happy?
Yeah, I'm happy to do these ones.
But a basic partnership or an LLP making a contribution in specie, selling a property into a SIPP or a SAS. Come on, step up, take bullet 2. I'm running out of steam. I haven't had enough caffeine.
You got the...
The second situation, the owner-managed business limited company, where the shareholders have kept the property out of the trading business. It's not uncommon to see this. So the property is often held in the same names as the shareholders, and ultimately, of course, and is already let to the company. That, of course, is automatically a property investment partnership. I say, of course, it is a property investment partnership.
So what we're saying here, importantly, is that the owner-managed business shareholders are essentially a partnership.
Yes, they are. Yes.
So they're essentially a partnership. So we're always thinking on these things about who is a partnership and who is connected. That's the basic kind of uncontroversial position, and sticking it into pension scenarios. So the same with the third point here. You know, all we're always thinking about is something a partnership? Is it connected? And that's the argument with a multi-member SIPP, isn't it, David?
Indeed,
you've got to look at the detail, and it's all the different entities doing businesses together, and what defines a partnership, which we're going to get onto.
Now, we'll come back to that point a little bit. I'm going to hand over to Roger at this point, because now the question is,
you want this? Yeah.
Is a pension a trust or isn't it? Because that's kind of key to the connected party analysis from our standpoint. I know you all know that pensions are connected to their member contributors and the members of their families, but somebody may not have explained to you exactly why. And I think the why is important. Roger.
Right, hi. Well, one of my favourite quotes about tax was by Lord Hoffman in around about 2003. And he basically talked about that as being a world of legal fiction and inverted realities. Well, I'm afraid you've entered a world where everything's upside down. Exemptions, exceptions, exemptions, and everything. Now, having a quick look at pensions with their trusts or not. I'm going the wrong way.
Yes, you are.
Right. Generally, most pensions are set up as trusts to start off with. Though actually quite a few of them are contractual, and some of them are even more complex than that. Pensions can invest in the pension fund directly or through investment vehicles. You all know this. Your SPVs, your offshores, your insurance bonds, right? For tax purposes, though, what we're looking at, the legal form of the pension, is actually not relevant. You're not looking at form, you're looking at substance. And this actually comes down to pension law itself. Basically, trustees don't like holding things in their own name, and they hold them in SPVs. And a lot of trustees previously used to have them as offshore SPVs with offshore directors to keep them outside of the scope of tax. Well, that's not why pensions are outside of tax. For tax purposes, we're looking at the pension arrangement as a whole. We're not looking at a pension fund gross, we're looking at an arrangement. And I think most of you will remember that somebody can have one pension fund with several arrangements. Each time I put an additional bonus into my pension pot, right, that comes back as a separate pension policy. That used to be important for flexibility in drawdown. Since 2007, that's become much less important. Now, looking at pensions, right, if it's a recognised in pension scheme, it's exempt from tax because of sections 186 and 187 of the Finance Act 2004, right? There are other things which tell you that you look at the whole of the pension fund, you look through the structure. You don't say there's a pension fund and a company and a bunch of companies underneath it. And if you look at HMRC's manuals on this, you look at the Pension Taxes Manual. I can give you the references later. Could bore you senseless on them now, probably not a good idea. But in the notes that we send out later, I'll put down the different notes from the manuals on the pensions tax and on the trust manual, which show that you look at the whole of the structure straight throughput. So what about multi-member SIPPs and sub-funds? Well, as I said, the legislation talks about recognised pension schemes, but it also talks about arrangements. And for the purposes of this talk, I think what we really need to take away is that sub-funds, because they are generally independently managed, so in a SIPP or a SAS, the trustees will have asked the members to either manage the fund themselves or to appoint the managers and manage them indirectly. They are separate persons for tax purposes. So whilst you might have a master SIPP with 100 members, each sub-fund is separate. So if you've got two sub-funds who join together in taking out an investment, they are actually in partnership. And that's been quite accepted by HMRC.
You're going the wrong way, yeah.
Right. So I've now actually told you about arrangements, historically how it's done, so we can jump through that and I don't get told off for overrunning. David mentioned that one of the key things is that SDLT is based on the consideration paid from the buyer to the seller. But if either the buyer or the seller is a partnership, you need to look and see who everyone is connected on one side and everyone on the other side who they're connected to and where there's connections across. That's effectively what it is. So that's why I'm going to bore you senseless about connections. We do know the old story of within six friends of friends of friends, everyone is connected to everyone in the country. It's a little bit like that. So I won't bore you with the science or do a Magnus Pike and start waving my arms around, which I tend to do normally. I'm just going to quickly run you through what to me is fairly obvious. Right. This is the legislation. Read it at leisure later. That's fine. In terms of connected parties generally, this is the starting point. However, it's been moderated for pensions, and this is where it comes down. That's the key point for the pensions. Of course, there is, back in 2004, you had the Pensions Act come through. On the back of the Pensions Act, you had about 9 or 10 statutory instruments, all regulations. And in the different regulations, several of them also moderate how you look at connected persons. So you really can go down the rabbit hole and find yourself in a warren if you're not careful here. Okay, but you don't want to do that, do you? You just want to know what's happening.
Well, yeah.
Right, so who are you connected to? Okay, so you, if you're married, are connected to your wife, or and your children and your parents. You're connected to your wife's family. That's her brothers, sisters, parents, children. Oh, and you're connected to anyone that they are married to. Right? That's a starting point. Not too bad. Right? When I say husband, wife, I do of course mean civil partner. I am sometimes politically correct. Now, what about companies?
Or trustees.
Well, I'll look at trustees first and I'll look at companies next. I think most people in the room, I hope, are comfortable with the fact that a trustee is connected to the settlor of the trust, the person who set up the trust. Oh, of course, yeah, you come back to anyone who's connected to the settlor. So Joe Blow puts money into a trust, well, all of his family and all of his next generation wider family are caught. Now, close companies, whether they are close companies in the UK or whether they're overseas companies which would be close companies, if they're owned by the trust or if the trust has shares in them, they're participators, so it doesn't mean they have to control them totally, right? Then they're connected, and obviously anybody connected to that, right? Now, I mentioned master SIPPs and sub-funds. If you've got a master SIPP with one trustee and it's got 100 sub-funds, and those sub-funds may have different trustees for them, or they may be managed by different people who you'll see later are also treated as trustees for this. Well, what happens is the trustee in the master trust is connected to all the little babies beneath him, all the trustees of the sub-funds. But also, each trustee of the sub-fund, if they're different, is connected to all the sister or brother sub-funds. So it's actually incredibly wide. You got that? It's wide. Okay. Okay. Now to companies, you won't be surprised that if somebody controls one company and they control another company, then the two companies are connected. But again, you've got to look to connection. So if I own a company and my fictional brother owns a company because I don't have a brother, right? Those companies are connected because I control this company and someone I'm connected to controls the other company. So that's how that works, right? So that won't surprise you. But it then goes down to, we also look at who else might control. So it's not just owning the company, control. So I've got a company which is in a little bit of a dire straits. It's got a property and it's got a big loan from Mr. Loan Shark. I can't be bothered with the banks. The loan shark controls me. You can believe the loan shark controls me, right? Well, we're connected that way. So hopefully this doesn't apply to anyone in this room. Okay.
I think you should ask the question. Does anybody in this room owe a large amount of money to a loan shark?
Right. Okay. Now, I said that there are some people who aren't trustees but can be treated as trustees, and this is often forgotten, right? For the purposes of pension trusts, someone who has management or ownership of assets which form part of the trust fund is also considered a trustee. So you can't hide and say, I've got a trust fund, but I've alienated the assets by giving it to someone else to hold. And we're not talking here of somebody acting as a nominee or whatever. We're talking of maybe if you sell it to an insurance company behind an insurance bond, but you've still got control of it. Well, both the insurance company and you are connected to that company. Okay? Right. I have a feeling that I'm about to be kicked off.
You're right.
Okay. What I've just said, and a lot more, is in some notes that I've got. He's told me to cut them down, but you will see the wider notes later. Okay?
Thanks very much.
There you go.
Actually, I might go back on that because when we were putting these notes together, I was reminded that one of the first people I tried to employ in my practice was a qualified barrister who was a lecturer in family law in Nottingham University, Nottingham Trent. And on her induction morning, she said, what would you like me to do? And I gave her section 1122 CTA 2010. I said, there you go, connected persons. Write me a plain English understanding of that. 45 minutes later, I heard the book slam, this voice mutter, I don't know how you lot handle this, bleep, 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 and that was then the door of the office banged. Never saw her again. Don't know why. It's simple, isn't it? No, it's not. But anyway, the reason I put that one up is that's probably the last functioning brain cell you've all got left, having heard just how wide connected parties are. It does genuinely make even grown barristers cry at times. So why is the SDLT not due? As we've said, it's normally calculated on the price paid or the market value if you're connected, and broadly it's correct. But the rules on Schedule 15, the partnership rules kick in. Why do they kick in and override the general rules? Because it specifically says so in Schedule 15. This schedule will apply in priority to the general body of Part 3 Finance Act 2, Part 4 Finance Act 2003. So you have to do this little calculation which says you take the market value, you multiply it by the result of a 100 minus the sum of the lower proportions. Welcome to algebra, parliamentary style. Sorry, Baroness. And the sum of the lower proportion is the profit share of all the persons connected to the transferor or the transferee, depending on which direction you're going. And you can imagine, if I have a family partnership, it's myself, my wife, and we have a portfolio of properties, and then we transfer that to a company that we own the shares in, well, although the company is the acquirer, Schedule 15 kicks in, take the market value of the property times 100 minus the sum of the lower proportions, all those persons, those individuals connected to the company. Well, that's all of us. So 100 minus 100 is nil. For the mathematically illiterate, market value times nil is nil. And sometimes with this, you can end up with a small percentage. Generally not in the pensions environment, but outside of that, you can do it. We've seen it. And as I said, in the incorporation and pension property transactions, it's generally nearly always 100%. So just a quick example, funnily enough, the one I've just given you. I'm going to sell my Joe and Pete. I'm not Joe and I'm definitely not Pete. But anyway, Joe and Pete are married. They trade from their offices. They're going to sell those offices to their joint SIPP, take a lease back. The SIPP pays out £500,000. Very nice, thank you. Wish I had that much in mine. And the SDLT due is nil, which is exactly counterintuitive to what you would all think. Why? Well, Joe and Pete are a partnership. They're also connected to each other by marriage. Join that dot. They're also both connected to their SIPP. So the SIPP calculation under Schedule 15 is, well, the SLP is 100. The SDLT chargeable amount is pretty much what I've walked you through. You come down to 0. And the important thing to emphasise here is that that is the right answer. It's counterintuitive, it sounds wrong, but it isn't. And in relation to corporate sales or individual sales to a group scheme, and if I go through some of the scenarios for a second, you might understand. In the last 2 years, we've seen a company selling to itself and a group SSAS. Well, there's your partnership straight away, even if you don't want to worry about that. We've had one sold to 3 SIPPs acting individually, but acting in concert. We've had one sold to a multi-member scheme. So they're all different examples of the same paradigm. So a limited company wants to sell it to its multi-member scheme. The SDLT definition of partnerships is much, much wider than it is for income taxes, insofar as it's not constrained in the same way that the income taxes definition is, and indeed a lot of the income tax loss relief. And the usual definition you work off Section 1 of the Partnership Act 1890. Partnership is a relation in business subsists between persons carrying on business in common with a view to profit. Well, pension funds and their members are definitely persons. The sub-funds are persons for tax purposes. Remember, you think in terms of rental income, but the revenues manuals describe it as property business income. So hang on, I've got multiple persons and I've got business. I've had one comment which said, yes, I know, but the whole thing's entirely passive. It's an investment. It's not therefore a partnership. In fact, somebody even told me it couldn't be a partnership because pension schemes aren't allowed to trade. Trade in tax terms is fundamentally different to business, ladies and gentlemen. Business is business, trade is trade. Schedule 15, however, specifically refers to property investment partnerships. So the fact that the property may be held as a passive investment is not relevant to SDLT. And that's what gets you home on the partnership argument. Of course, as I've already said, the revenue haven't given us an argument and don't appear to be. And that's where we're at. So passivity is not an issue. I had somebody comment, and I'm going to say how many people in the room nod. When you register a pension scheme or a multi-member scheme for VAT on opted property, do you not have to use the partnership form to register it? I regard that as a fairly large smoking gun, that the revenue regard them as partnerships. Maybe it's just me, maybe I'm just a tax guy. I don't know.
We live in a different...
So any joint ownership, any form of joint ownership is effectively and treated as a partnership for SDLT purposes. And this is the area, and you're kind of getting a sense of the complexity going on here. And I'm going to be unkind to solicitors, and I apologise in advance.
You usually are, and you rarely apologise.
These are friendly solicitors, I'm going to apologise, but I've never met anybody who went into conveyancing because he wanted the excitement. Yeah. It's not an area that changes all that often, and unfortunately one of the things we continuously see, and bear in mind SDLT has now been with us for 18 years, we still see solicitors saying, but it's just like the old stamp duty, isn't it? I think it was it you a couple of years ago had a solicitor who insisted that you couldn't get group relief because there was provision in the Partnership Stamps Act 1890, and we had to very gently point out that the Stamps Act 1890 hadn't applied to property since 2003. Oops. I wonder what he'd been filling in for the last 17 years. You're going to do this bit.
Don't worry, I will be fast.
Elvis is going to leave the building at this point. Yes.
You've got time for your fag break?
No, I'm not doing that one then.
Right, okay. Well, as you've heard, and I think you're all aware, SDLT is a self-assessment tax. What this means is the taxpayer has to work out if they owe any SDLT, how much it is. They've then got to report it to HMRC, and they've got to pay it to HMRC within 14 days. It used to be 30 days. So it's a responsibility of the taxpayer.
Keep clicking.
There. You can read that while I wobble on. Where a sub-fund of a pension buys property, the question is whether the sub-fund is a beneficiary, whether the sub-fund, or the beneficiary of the pension fund, or the trustee is the buyer. The answer is it's the trustee or the sub-fund. It's always going to be the trustee who's going to have responsibility. But of course, who's going to pay the stamp duty? Well, that comes straight out of the trust fund. So who's economically going to suffer? It's the member of the member. Right? So the trustee doesn't really have any skin in the game on SDLT, apart from it's their responsibility to get it right. Of course, SDLT is quite complicated, so trustees tend to say, pass the buck to a lawyer. Problem is, sometimes they're passing it to, hey, this one's just done a divorce for me, and they're going to do something else for me. They don't necessarily think of the most appropriate solicitor for the job, somebody with the expertise, right? And the problem there, well, there's several problems there. You can delegate the task, but you can't delegate the responsibility. If you've appointed a divorce lawyer to deal with your SDLT, no, I'm not in the middle of a divorce. If you appoint a divorce lawyer in the middle or into SDLT and they get it wrong, whose fault is it? Right? Just to remind you of the responsibilities of trustees, bit of a news flash here. This morning there was an announcement that a certain pension provider, Castle Trust Management, right, off in Guernsey, is being sued by 60 investors for a parallel to this. Right? Not because of stamp duty problem, but because they have allowed people to transfer funds from CureOps to them, and then they've then presented to the members, hey, we've got a couple of investments you might be interested in, and they forgot to advise the investors, by the way, you might want to take security because they've just gone bust. And you've got 66...
Sorry, I've just been advised by a member of the audience who wishes to remain anonymous that they're actually in Gibraltar, not Guernsey.
Oh, Gibraltar, Guernsey.
How he has that information and why he has that information, he wasn't willing to disclose.
Right, anyway, yeah. It's not in England. Not on mainland UK. Anyway, so this has gone to the courts, and yesterday the court said, sorry, you've come to the wrong court for this. You need to go back to Gibraltar. Trustees can be responsible for things where they've delegated to their members to take a decision. They've invited the members, do you want the fund to invest in this? The members said yes, and they got it wrong. If you've asked, do you want to buy the property? Yes. By the way, don't worry about the tax, you just paid it. I'll be careful in what I say there. I can ignore most of the rest of that page. Ross has already mentioned that you've got 4 years in which to claim a refund if you've overpaid tax. So you're going to have to really get your skates on to review cases if you feel that this might apply to some of your clients. But what if you think, it's all going to wash away, it's all going to disappear. 3 months, 3 years, 6 months, a few months, it's not going to be a problem anymore. Okay, what is your problem there? You're responsible for maximising the value of the trust fund for the beneficiaries. If, because you have decided not to take any action, they lose out, could they claim against you? Oh dear. They might do. So, although we have this 4-year, we've got to consider what happens next. Do you want to be seen as somebody telling your members, we heard about the problem, but we didn't do anything? Or do you want to say to your members, we heard of the problem, we started to act, but we ran out of time. Do you want to talk to the solicitor? They've got better IP protection than us. So you've got to look about protecting yourselves, and it's your duty, or the duty of any trustee, is to the beneficiary as long as they're legal.
Okay, we're running out.
I will now back out before I say the next few sentences. Okay.
Thank you, Roger.
Right.
So, ladies and gentlemen, I think that, to use the phrase, probably covers it. So what do we say and we believe is the way forward? Well, you're all involved in pensions here, so if you've got multiple persons involved on either side, you need to ensure going forward that advisors are appointed who understand it, or that the clients are recommended to get advice. And I know that there are 1 or 2 firms in the room that have already updated their guidance to solicitors and their guidance to clients to make sure that problem is insulated going forwards. For past transactions, you need to go back and do this review of 4 years, identify potential cases. Indeed, one of the firms in this room, I think 2 of the firms in this room have now done that. 3, obviously approach potentially infected clients. I would not recommend as a tax advisor. I don't do pensions advice. I don't expect you to do tax advice. Write to your clients and say, look, we think this one might be affected. We think you need to go and get advised on it. Clearly, you could act as a conduit for it and help facilitate the management of that. And then get on with reclaiming the tax. 4 years is the absolute limit. The last day, I think in the last 5 years, I've done 2 what are called last day schemes, where we found out about it with 3 days to go, got all the papers together, and actually stuck one on the back of a motorcycle and had it hand delivered to Stamps Office in Birmingham at 10 minutes to 5 on the last day of the 4th year, and we got the refund. We will go the extra mile. I won't go so far as to hire a helicopter and fly it low over central Birmingham. A bit like flying one low over central London. Not good for your health. More stories about Bradbury lines later. And really, that's it. I think, thank you very much for listening. Thank you to my co-presenters. And I'll throw the room open to questions. If somebody's got nothing to ask, feel free to fill your face with what's left of the sandwiches. Yes, sir.
The dates for the legislation coming in, it was obviously 2005 when the legislation was drafted, but it was only enacted?
No, it was first enacted in 2005, if you're a real anorak on tax.
Do you know when exactly in 2005?
Oh, gosh, I can't. Do you remember when partnership provisions came in? But it was then amended in 2006 because the original provisions, some very clever barristers found a way around it. So then in 2006 they amended it again to take out the ability to get around it, and then those same clever barristers got around it again. So in 2007 they finally amended it. So really the operative provisions we're talking about are really 2007, because I'm going to use a phrase. Now, Roger, you remember there used to be plus AC in there? And they took AC out, and we all said, why have they done that? Because actually, the plus AC, by the way, was the inverse calculation over actual consideration. Had they left that in there after 2007, we wouldn't be having this discussion, because everything would be caught. But weirdly, and Roger was in the room with Crispin Taylor, who was the Director of Policy of Stamps at the time, and he said, we are aware of this sort of leakage, but we're quite happy with it.
There's also VAT added onto the stamp duty.
Yes.
That registered building. I bought my building in February 2005.
Oi.
hit for the stamp duty
And the VAT.
and the VAT on the stamp duty. I was just curious to know the date.
So-
and,
so of course
you
he said, reaching back into his brain, what was VAT on those days? Was it 15?
17.
It was 17. So you'd eventually paid 4.68, 4.7% stamp duty, because of course, whilst you could recover the VAT, you can't recover the stamp duty on the VAT.
I could put it on the VAT, but not that.
But you know, it's. I mean, we get probably 30% of the work we do in commercial buildings is we get parallel questions on and VAT. And how could I do a TOGC?
You'd be amazed at how many people don't understand TOGCs.
You'll be amazed how many people, I know we're slightly sideways on this, but where a developer acquires land for residential conversion or opted land for residential conversion or construction, you can disapply the option to tax by serving notice on the vendor. Last time I got asked that question was 8 months ago by the finance director of a PLC. He didn't know about it. I do worry at times. I mean, it's a side dish to a 1614D, isn't it, if I remember?
Yes.
Anyway, sorry, hopefully that's covered it off. Any other questions? Right, we've bored them all into submission. This is good. Oh, sorry, we haven't.
So we've done quite a lot of Section 162 incorporations of jointly held property. Kind of always took the view that whether there is an existing partnership is effectively a legal question, but it was covered earlier on that the tax rules effectively override
Yes.
that.
Uh-huh.
Could you just
The thing about
cover that for me?
the 162 incorporation is that you do need to have actual income linked to this. And there are quite a lot of cases which have gone through to see, well, at what point is it a passive investment, which would still, for stamp duty purposes, stamp duty and land tax purposes, be a partnership, but not for income tax purposes or capital gains tax purposes. It's a passive investment.
Arguably.
Three tax guys in a room, you're going to get 4 answers, I guarantee this.
The best thing about the incorporation, though, is that there have been quite a few cases that were really good anti-avoidance cases that every tax lawyer learns about. It's called Ramsey. Now, 30 years later, there's another court case called Ramsey, and this one, that was the revenue in. Because in this case, you have had a little old lady who had a house which had 4 flats. And she did a bit of gardening, and she tidied the flats now and again, and she rented them out. And HMRC said, no, that's nothing more than a rental property, it's an investment. The court turned around and said, no, because she was actively involved in maintaining the flats, doing a bit of gardening, getting the maintenance done, it was a business for income tax and corporate tax, capital gains tax purposes. So she got 162 relief, right? And that is the current view. Now, if you want, I can give you a list of about 15 cases on this. And you'll all be dead because I'm just talking. So it's a well-trod path. You need to make sure that the people are actively involved in managing the property. It's not passive investment.
So the 162 aspect's quite happy with, but the SDLT is different, isn't it?
So the SDLT is more liberal than for the 162.
Yeah.
Because you don't need to be actively involved, you just need to have it as a joint enterprise.
And understanding why it was more liberal, you have to remember this was an anti-avoidance provision. They wanted to make it as broad as possible to catch as much as possible. But actually, in this context, accidentally shot themselves in the foot, or slightly higher and more towards the centre line, I'm not sure. But
And more importantly, you don't actually have to do a partnership return. They accept, you know, if you've got people running a property business, whether or not they've been doing, whether or not they've been doing partnership return is sort of supportive, but it's all about the partnership definition. And we had HMRC specific confirmation on that point in the days when they actually still did clearances, so they're happy with that.
you have to remember that the Partnership Act 1890 actually goes on in Section 1 to say whether or not reduced to writing. There is this concept in law of partnership at will, verbal partnership. I shake hands with Roger, we're a partnership from that moment onwards. I hesitate to say that's in a business sense, he's not my type. But, you know, so you've got this whole thing that there can be undocumented partnerships. And the revenue accept it.
You can't actually get a UCR, jointly held property, can you, as a partnership?
Well, you
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 can.
can actually
I
say you're a
have.
partnership, yeah. Particularly
But-
if you're an LLP, but I think you can send this in and say you're a partnership.
HMRC is quite happy to issue a unique tax reference number if you write and say, here are the 3 or 4 partners, we're in business because we're going to be renting out properties, managing rental properties. They'll quite happily do that.
Our experience is they'll often resist.
I just provide them with a partnership deed to say, oh, okay, fair dues, Gav. And that's very often it's family partnerships, you know, mum and dad and 3 kids own property between them kind of stuff.
Indeed, we've had situations where we've come across family partnerships that have subsisted at will for a number of years, and that may or may not be an open question. But the solicitors in the room will know. So what we've done is we've done a retrocessive deed. A retrocessive deed is, we're now reducing it to writing, but it commenced a few years ago, and that's perfectly legally acceptable. It's not backdating, never get involved in that. But giving written evidence to something that has always been verbally agreed is acceptable under English law. So again, you can do, if you want to copper bottom your partnership position, that's what you do. But I mean, I can't think of a time. Genuinely, we have never had a problem with stamps on this. It's you know, look, they are a partnership. We've had properties that have been held in sole name, but the income has been shared amongst the family members. And again, that's a partnership at will, with one partner holding as trustee for the other partners from time to time, which again is permissible law. As you may, or the non-lawyers amongst you may know, may not realise, you can't register more than 4 names on a title deed in this country. So where you have a partnership of more than 4 persons, you've got to have a written deed where, though the 4 named partners, or however they hold on trust for the partners from time to time. So this whole concept is valid and exists.
Another issue, I suppose, goes back to around about 2000, where HMRC was, well, it was in the revenue back then. No, it was just later. We're saying that
It worked back
joint ownership and partnership aren't the same thing. But they've rolled back on that. I don't know of any recent case where HMRC has said, no, that's joint ownership, that's not a partnership. And that's actually quite an important fact there.
I think one of the problems is that, again, with that, is that, again, they got, was it Susan, HMRC v Susan Moyne-Ramsey? The Susan Moyne-Ramsey case. The judge was quite scathing on the appeal. And he said, look, you yourselves call it property business income. You say in your own manuals these days, in your own guidance notes, these days most property portfolios are run as businesses. And now you want to stand here and tell me, for capital gains purposes, that this is not a business. And you can see counsel for the revenue saying, well, yeah, I know that's what we said, but it kind of wasn't what we meant. And then they got right royally slammed. It's just one of my favourite cases as well. Although, in fairness, I actually think one of my favourite cases is the Bewley case.
Oh,
Well,
yes.
was it residential or not?
You guys have got to read the Bewley case with some of the
No, you haven't. For you, it would be a cure for insomnia. For us tax guys, it's brilliant. But there's one line from the judgment, which was by a tribunal judge and a chartered surveyor sitting as a paid associate. And he said, at times we had trouble following HMRC's arguments. Indeed, at one point, we wondered whether they in fact had one. That's about as damning as it gets in a judgment. But there you go. Sorry. Any further questions?
In terms of transactions that have been affected, what's your instinct as to the numbers?
We've had some commentary from one trustee that they quote, you must be wrong because we do hundreds of these every year. Oh my God. You know, it was like, really? I've been trying to get a metric on this, and it's been impossible. One simply can't. If one takes that on faith, multiplies it out by the number of trustees, does a finger in the air, somewhere between 5,000 and 15,000, I think, have been affected. Which
property into a pension fund is
Yeah.
so efficient, so tax efficient. It really is an exceptional opportunity. So if you've got a financial advisor and he knows you've got, she knows you've got a property and you could be putting it into a pension, why would they not do it? And that, I mean, that has been very, very popular, and it's something that so many advisors have helped people with for really valid and strong reasons. So this is just another element of the advantages of putting property into pensions, of which there are so many.
And accountants were consistently, over the last 21 years, telling their clients to do it. As a former general practice chartered accountant, before I decided to completely fry my brain for the rest of my natural life, typically 60 to 70% of my unincorporated clients were family partnerships. So I know that on the main, because it made sense to make your wife a partner, because then you've got 2 basic rate allowances. This was good basic income tax planning. So that, Arkwright and Sons, and that ages me, doesn't it? But family partnerships, father and son partnerships, large professional partnerships. These things were and still are the currency of our family business and owner-managed business life, and that is the sector that has been doing this for a number of, I would almost argue since time immemorial, but I won't.
Another issue, I think, is that there's a tendency to think if you've been doing it this way for the last 10 years, it must be right. And we've still seen people, as I said, recently ask us, well, stamp duty doesn't do this, and no, it's not stamp duty land tax. And in the days of stamp duty, it was a regular argument as to whether the transfer of property into a pension fund involved stamp duty. And I remember having long discussions with pension funds and HMRC about contribution in specie. And even in the manuals, they could never quite work out whether the contribution in specie, and generally the answer was, it's probably got stamp duty, so you might as well. So people who operated under the old stamp duty regime are probably assuming SDLT, because it's got stamp duty
in the
at
name.
The start of the name,
It's
must be the same.
It's not.
So there's a little bit of a legacy issue here, I think.
I mean, just as a matter, when Baroness Altman mentioned it, she was quite shocked to find out just how many reliefs and exemptions there were. Bless. The reason she found out was that I had been quoting a number to her all the way we've been talking, and I seem to remember it was 43, wasn't it? I was trying to get down to 42, so it was the meaning of life. And she put me to the test one day. She said, well, go on then, send me a list. Christ. So I did. And I went down and I constructed the list and all the manual references, and I rang her up. I said, I'm terribly sorry, Ros, you caught me out. It's not 43. She went, thought so. I said, it's 49. When I used to lecture for Central Law Training, and I was their stamp duty land tax lecturer, we used to go into a room. Shame we didn't do that before I made the remark. We used to do a show of hands game with the solicitors. And you say, right, hands up who think there are 5 or fewer reliefs for SDLT. And about a third of the room would do that. And hands up who think there are 10 or fewer. And the other third of the room. Hands up who would think there are 15 or fewer. And every hand in the room would go up and you go, well done, folks, there are 43. At which point you see this like rabbit in the headlights look. Whilst we're talking specifically on one issue here, I'm going to come to the defence of property lawyers at this point. They are not tax experts. And at the end of the day, whilst, sorry, Mum, ignorance of the law is no defence. It's a bit like situations that I've seen where, again, go back to CLT, 2/3 of the people in the room were actually administrative staff. They weren't even qualified solicitors. SDLT was regarded as, oh, just give them the file, get them to fill in that little online return thingy with HMRC and hit the button. And, I mean, even in the last 12 months, outside of pensions, we've seen some corkers, haven't we? Including one gentleman who was asked to overpay his SDLT by 1.36 million because of a simple basic error, which we found, and we got him the money back, and he's a happy bunny. So was my finance director, because we charge a success fee, but that's another story. Any more questions? Go on then.
Talk through linked transactions. So the idea that, cases that I've basically purchased half the property X amount of years ago. They've just purchased the other 50% about 3 months ago. and they've paid the SDLT on the original purchase,
Uh-huh.
and they've been told they need to pay it again on the second
Right.
tranche.
Now, there's two things there. Then you've got partly a conveyancing issue, right, where you've got it in two lanes and you're conveying it to one. So in conveyancing terms, they're going to see it as a transfer, a purchase by one person. But you then need to look back to Schedule 15, and what you've got is they're only going to pay SDLT on the half that they're acquiring, not on the full. I had that great fun with Ray Brick and one of his clients a while back.
What if they paid SDLT on the original transaction?
When they purchase the property, you'll have had two people, and hold my hand carefully, two people, right? And they'll have paid, let's say they paid £1 million for the property, and they'll pay SDLT. In between them, they'll have paid SDLT on it. So effectively, this person's taken the burden of half the SDLT, and that's taking the other half. So when this person is buying this, right, you only need to pay on the second half. You're not looking for
Section
a credit on
108.
SDLT already paid. You are only paying SDLT on the portion you are acquiring. Right? Now, although they're partners and they're connected people, if the only reason they are connected people is because they're members of that partnership, then I'm afraid they're still called as two separate people. If, however, you can persuade them to do a quick shotgun marriage down the corner, then you're okay.
I don't think we're allowed to say shotgun marriage, are we, anymore?
No.
Is it shotgun civil partnership? I don't know.
But anyway, sorry, did that actually answer your question?
Were you leaning in the direction of, if the second part transaction is covered by Schedule 15, can you go back because it's a linked transaction and extend the repayment period?
Yes, because I think the actual original purchase would have come under this legislation as well.
Uh-huh.
So I believe the original purchase was from a partnership.
Can you ask you, send us the details on that, because there's potentially scope. There's an argument.
Certain people here and you already have them.
Oh, right, okay, in that case, I'll email with the details and I'll have a look at it. There's an argument that because a further return is required, that it reopens the whole transaction, which is where I would argue. I'm pretty certain the Revenue will dig their heels in and go, no, first one's over 4 years. But since the return, and by the way, there's the little point we didn't mention, this isn't a relief. What you do is you don't furnish a return at all, because the consideration is less than 40,000. You just write to the Revenue saying, we're not doing a return, here's why. And in same terms, you write to Land Reg, and Land Reg will register without an SDLT 5 return submission certificate. Just an administrative point for you.
And the important thing of writing to HMRC and saying, here's our calculation that there is no SDLT, that the deemed chargeable consideration is less than 40,000, so we do not need to send a return under Section 6. By sending that letter to HMRC, you've given them the information. They can't suddenly say we discovered from looking at land registry records that you bought the property. You actually told them, and so you're clean. You've got clean hands there, and you're avoiding all kinds of problems. It's very important to make sure you write even when there's no SDLT.
Yeah, the irony, of course, is that when SDLT first started, you could have filled in what was called an SDLT...
1.
No.
No, 5.
5, no. Yeah, no, 5's a receipt. 6, self-certificate. Anyway, certificate that no return is required, and that enabled you to get registration. The Revenue rather helpfully abolished it because they said they couldn't see any further need for it. Interesting, but there we go.
Can I just ask you a question on plain simple pension rules? Because in case I'm disappointed, I've been dealing with SSAS and SIPPs for 30 years.
Mm-hmm.
So this is all to do with connected party, though, isn't it? So
Yes, it is.
So effectively, if I own a piece of farmland, I put it into my SSAS, it falls into this.
Mhm.
If I decide to buy my farm next door neighbour's piece of land, it doesn't.
Correct.
Yes.
It's as simple as that.
Yes. Unless you're in a farming partnership and he's already part of it.
Yeah, assuming the separate.
If there's no...
I was about to say all your farms in Norfolk, in which case you're all related.
I could say Foxtrot.
Sorry about that one.
I am from Norfolk. Yes.
No, so's my wife, and believe me, yeah, absolutely.
Yeah, so okay.
See me afterwards.
Connected party rule.
But yeah, it is the connected party rule. What's intrinsically, and I don't want to rain on the parade too much, but connection need not necessarily be direct. It can go through one or two hops as well. So I had a lawyer down here last year who was arguing bitterly that because the connection was indirect, that the two weren't connected, and I went, sorry, don't think so.
And after 4 years, it's tough.
Also,
Yeah, you're stuffed, yeah.
in the world of pensions, the connection is actually widened to include associates rather than just simple control. So it's actually wider within the pension world than it is in the rest of the inverted world.
So coming back to claiming, you have got in the last 4 years, and ultimately it's the trustee's responsibility, for example, of the SAS to go back to put the claim. Yeah. Not the members, it's the trustees.
No, it's the members. Trustees on behalf of the members because of the default provisions of, funny enough, SDLT on trust specifies that the trustees are responsible for the return. Yeah. Okay. Well, they are indeed. It's, you know, I'm sure you have as much trouble explaining that to lay clients as I do. You know, you are your own trustee, but you've got to work out which capacity you're acting in.
Okay. So we've got to look back 4 years. Okay.
But for older ones then, you know, that you can't go back to, you've got a risk. Is that a PI notification then?
Well, that's the question I was just about to ask. Yeah, is that a PI notification?
You have to arguably be becoming aware of it. Are you under, as a trustee, under a duty to act on behalf of the members and make a claim on the person responsible for calculating the return?
Embarrassing.
So is it just property or stamp duty on quoted shares?
No, it's just on this is SDLT, stamp duty, land tax. So your duty on shares you don't have a problem with.
It's land.
It's land. If it's land, it's an interest in land, it's an interest in a partnership, anything that would be chargeable to SDLT, this is where the thing kicks in. We don't worry about exempt interest. I'm not even going to go there today. Anybody want to watch the online series of courses, feel free. But it's genuinely just about connected parties and just about interests in land. But I guess pension schemes only ever usually get involved in quoted securities, don't they? I mean, you can tell my pension fund's in property and cash, so I haven't got a Scooby-Doo. But you can do private companies. There you go. Something I didn't realise. I shall have to invest in myself when I get home, but there we go. Any more? So sorry, gentleman at the head of the table.
Sorry, again, sort of going a bit back to basics here. If you have a two-member SAS, husband and wife, they buy property from themselves, that's the partnership there, that's broadly what you're saying. If you've got one-member SAS, it's one member, it's not a partnership.
It's not a partnership, but who's it buying from? Fred Smith.
Let's say one person, or himself.
The basic rule is what we call the many-to-one rule. So if you've got one-to-one, you've got tax. If you've got one-to-many or many-to-one, you've got no tax.
Okay.
Is that a simple? Think of it in terms of database relationships, and you've got the idea.
Okay. Let's say it's coming from one.
Yeah.
But it's going to a SAS that has one member, but he's appointed his wife as a trustee to sit alongside him. Two trustees, one beneficiary.
I think I would still argue that's a single member because it's the underlying number of beneficiaries. It's definitely connected. You know, my quick advice is stick your wife in the SAS fast.
Yes, that would be it.
Yeah. You know, I'd never looked at it. 2 years ago, I was asked a question over lunch by a gentleman who's sitting at the top of the other sprig, Rishi Chandarana, who said, Dave, why is it that the partnership rules don't apply to pensions? And I went, hang on a minute, they do. Which started a feverish bout of reading, which left me with a headache for about 2 weeks. And from that, I think we advised 3 or 4 of your clients, did a couple of refunds, a couple of pre-transaction clearances, because we were like, as confident as we were even then, we were like, no, we need to check this. So we found a couple of clients who were about to do the purchase and did pre-transaction clearances with the revenue.